Hello, everyone, and welcome to the Hardcore Finance Show. And today, I'm very excited to welcome back David Blatt. David Blatt's episode last time, we talked with Shimon a lot about real estate, and obviously, we'll give you David's background in a second. But that was one of the best episodes that we've had. So I'm really excited to bring David back today because, well, the market is in a bit of a disarray, and real estate is the core of the American kind of family, of the American dream, if you will, and it's about to fall potentially. And so really quickly, before I dive in, because I'm super excited to have you and talk to you. But David Blatt is the CEO of CapStack Partners. They're an asset manager offering clients in real estate investment advice, capital solutions. He's also a founder and CEO of Banxel, the first lender-to-lender marketplace to syndicate, buy and sell real estate loans. So today's going to be real estate heavy, debt paper heavy. Welcome to the show.
Thank you. Thanks for having me back.
All right. So first question, before it was softballing with you, but now we're gonna hit it right out of the gate.
I love it.
Are we in a recession?
Yes, absolutely. Yeah, we're certainly in a recession. I mean, it's just you can't look around and suggest otherwise. Right. So, I mean, I think, every headline is more about like soft landing versus this just precipitous drop that is trying to be managed. No one's talking about pushback, to the upside, at least in the present. So, 100%, listen, the other thing is this, right? Let's just think about where we came from, from the great reopening perspective and, just how hot the economy was in that bounce back, coupled by the fact that it was, super juiced by a lot of the stimulus that was being injected into the market in the form of just plentiful money, so to sort of have this snapback tied to cost of capital in the most fundamental sense, inflationary aspects to it, it makes sense on at least an economic level. No one appreciates it when you got to go buy something at the store, but academically anyway, it just seems like it would be the natural progression, cyclically speaking.
Mm-hmm. Yeah. So I'm super interested to this is going to be you're going to teach Alex all about real estate and real estate paper because. So look, I understand enough. Let's just build the background for the audience, but I'd love to go deep with you. When yields increase, when the Federal Reserve increases interest rates, obviously it becomes more costly to borrow. So people's payments, there's the commercial and retail side, people's payments increase. And so when you're paying double or 60 or 70% effectively more, for your mortgage payment for the same property, it becomes very hard to go and buy. And we went from 0% rates or actually 25 BIP overnight rate to what I forgot what it is now, 3.5 or something along those lines. And one of the mortgage rates now are close to 7%.
That's right.
Right. And went from like 3.5, 3.25 to 7. So it's a major increase. And typically, again, we'll go deeper, but just to build the base, the way mortgage payments are structured is, you're paying a lot of interest up front. You're paying off your principal towards later and of a typical 30-year mortgage. What are you seeing on the ground? Are you, talk to us a little bit about are you seeing a slowdown? What's actually happening?
So I think, when you're talking about, you have a lot of constituents that make up a real estate trade. And so when you start at the debt end, which is most of the capitalization, right there, you're obviously seeing higher rates that exist today. And so lenders who are active in real estate, whether they be a traditional bank or a private lender or a debt fund, immediately you have to recalculate and recalibrate to the cost of capital associated with the trade, right? So right away, that is having, I would say, the most acute and immediate impact in the sense that you're going to have to reassess, re-underwrite, lend less to cover, right? So if you're looking at the investment property side of it, right, commercial assets, you have to consider, okay, well, if my debt service is going to run X dollars per month now, I need to have a certain amount of rent to cover that. And so that means I'm going to have to lend less, right? So now you've got less debt dollars on the table for a given real estate trade, which either gets filled in with equity on the presumption that the purchaser just absolutely is bullish on the asset that they're buying, or more realistically, you're going to see a no trade scenario because of the fact that you're not able to fully capitalize the deal at the price point where it may have been or remains today, simply by virtue of the fact that sellers may be in either a wait and see approach or just simply in a denial approach to a particular trade, saying, well, my asset was worth X yesterday, it's worth that today just simply because of that endowment effect. I own it, so therefore it still remains there. So what you're really seeing is more a slowdown in activity because you got to hit that bid ask in order to actually have trade activity with respect to any real estate deals, commercial or residential, right? So when you have one side that's still playing psychological catch up to the realities of the market in that money costs more money, therefore the asset is it's got to be repriced down, unless again the buyer comes in and fills in with their own cash that gap. You just have, like, call it the right now, and certainly I would say probably over the next couple of cycles, just the slowdown in activity before sellers, owners come to the new reality of, well, this is where things are as a function, firstly of interest rate, and then not even factoring in what the economic circumstances may be, macro or localized.
Yeah, there's a lot of threads I want to pull on that, but you mentioned, next couple cycles. How many cycles do you think, and your definition of a cycle, if you could estimate your best guess, until we see some sort of housing bottom? And well, actually, I should say, do you think prices will fall?
So I do think prices are going to come down. It's just, I think that you have too many pressures on pricing. So, you're touching on housing. So let's just talk about that specifically. Particularly, you've had such a hot housing market, which really was driven by kind of like the tailwind end of a lot of the fundamental aspects of things. The costs of things were less. You had a supply constraint situation that really was a tale from, talking like, the last recession, when the whole housing market tanked and everybody stopped building, so people tend to forget, we're going like almost on 15 years back, but that consequence and just sort of that effect of the pullback on development caused this acceleration of trying to just satisfy the housing need, which never actually got there. And then layering in that the home buyer started to compete with some of the bigger institutions who were doing the single family rental, which was an entirely new industry born out of that very same recession. So you had much more bullish sentiment, the cost to build, the cost of land, everything was in reach. And then you also had the cost of debt being as cheap as it's been for the last number of years, such that buyers could make sense of the higher pricing based on the fact that they could borrow at such low rates. Now you reverse that, you've got like massive supply constraint on the development side. You've got labor shortages. Land is less plentiful because so much of it was like snatched up over the last few years. And then you layer in the cost of the debt that we touched on already, and that just creates a tremendous amount of pressure to the downside. But at the same time, you're still not solving, long term, for the fact that there's still a tremendous housing need. Whereas before you were driving a lot of prospective home buyers into the renter category because they couldn't get their hands on stuff. Now they can't get their hands on stuff simply because they can't afford, the down payment's going to have to be greater, or, something needs to adjust again to make it much more within reach. And I think also buyers just psychologically have this sentiment simply that things should be cheaper by virtue of the fact that, everything else is, so negative, and that ends up influencing at least buying activity, which then translates into pricing. So I do think that you're going to see that downward pressure materialize, call it in the next, couple of cycles. As to like the crystal ball, when does this bottom out? Well, the good thing is if I'm right, I'm going to be like, you're going to invite me back onto the show. And if I'm
CapStack Partners.
That's right. That's right. If I'm wrong, no one's going to remember. So, this is an easy one that I'll field. Look, I'll tell you this. I don't think that you have the kind of crisis era issues, similar to what impacted housing and real estate through the Great Recession today, right? You have elements that are certainly creating that recessionary environment, and so typically those things tend to linger, for, call it, 4 quarters, 6 quarters, so I think next year is probably going to suck, from that standpoint, and my hope and prediction would be that we'd start to see a slow pickup coming back in, the following, call it 24. So
yeah, so it's interesting. So you're saying sometime in 23, there's even a couple of threads from here. Let me just ask you really quickly. You mentioned 2 things. You said, reduce supply, right? But also buyers and reduce demand. So what's going to outweigh what? If it's high demand, reduce supply, prices go up. Reduce supply, same demand, prices go down. Reduce supply, reduce demand, that's like an unknown, right? And
Sure.
We haven't even disaggregated the nation. We're just talking on average. Because I'm looking at the indices, and you're looking at like home builders indices, and they're falling as well. So people aren't. I mean, it wasn't yesterday. Today we're recording. It's Thursday the 20th. The show will come out in a few days after this. But I think yesterday or the day before they came out with the indices, and they're not great. They're falling, and they're falling pretty precipitously in terms of home builders.
Mm-hmm.
So if the supply of homes it drops and the demand is dropping, are we just going to come to a stalled market?
So I think, it's moving towards a stalled market in the near term, right? Part of it is a price discovery process that everyone is just internalizing. Home builders are dealing with the pressures of the cost to build with, do I have a buyer on the other side like I did before? So look, I think, longer term, I think we're going to come out the other side where the market starts to show a recovery and then picks up steam again. And then you're going to be faced with that same supply constraint problem that's going to drive pricing. Right now, though, in the near term, I don't think that supply constraint is going to necessarily work to the benefit of pricing per se, because I think buyers. Why? What's that?
Well, yeah, why? I'm really curious as to why.
Well, because I think if the cost to borrow is going to continue to trend upward and remain higher, buyers are going to expect to be able to pay less in order to make the numbers make sense, right? And granted, look, the purchase of a home is a very localized personal decision, right? And so, there'll be kind of like room within that, where people are willing to stretch and whatever. But, at the end of the day, you have buyers that have a certain nut with respect to what that deposit looks like. The rest has to be filled in with debt. They're only going to get so much debt based on where the rates are. And therein lies your purchase price, at least, or your buying power. And so if sellers are going to want to move things, they're going to need to adjust to that. And I say that on a macro, right? Because your counter as a seller is like, well, I'll just wait for the buyer that has a bigger deposit. Okay, but that's not a volume trade. And when you're a home builder, you're looking to move volume. So to that end, if your exit is a home buyer, you're going to have to calibrate to that. So the numbers will need to pencil. Either that or you're just going to have to hang on to inventory. And if you're hanging on to inventory, now you're putting pressure on the supply side of that.
And you have carrying costs.
Yeah, you have that as well.
Yeah. So do you expect, again, no crystal balls here. We're not going to hold you to this. Just order of magnitude, if you will. I know I'm going to keep pushing on this. What downside are we looking at next year when we're talking about real estate prices from today? And they're already starting to fall in different areas of the country, for sure. And then I want to ask you about my area. My area is really weird. I live in the DC area, and it's just like, it seems like nothing phases us. The great financial crisis, 07, 08, everybody was foreclosing, and DC was like, doo, 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 hey guys, what's happening? It's such a weird government tied kind of area. But what are we looking at more or less from a fall perspective? Like, how much more downside is there in housing prices?
Well, look, I think, until we get a signal from the Fed, that they're going to take the foot off the gas or even slow down on rate increases, you're just going to see continued pressure to the downside. And I think what you're also going to do is you're sidelining a lot of prospective buyers, right? So it's not just a function of the cost of the debt increasing for, let's say, a home buyer. It's that those home buyers there's going to be a segment of those prospects that are going to be sidelining to just wait until rates stabilize enough for them to be able to think about, where they are and going to be. So that influences decisions as well. And look, certainly if we're going to translate that to the investment side, where you're looking at, real estate investors on the buy side, that's absolutely the case. I would say that, we're talking, let's say here is 0.0 and then go forward, but let's consider how many investor developers bought into assets underwriting the ability to refinance at a certain value and a certain interest rate, such that in the best case scenario, they got a cash out on that refinance because they added value in some way, which is a very typical business plan. But certainly being able to bring their carrying costs down, and instead they're coming into a market environment where that's completely flipped, such that not only is it just simply that, they're going to have a higher carry, but the lender that's supposed to be the takeout on that refinance is now advancing fewer dollars because that very same cash flow isn't sufficient to cover the debt at the levels that the lender needs. So you're creating a huge population of borrowers that are coming up on loan maturities that are going to have to solve that with equity if they want to hold on to the asset, or by selling, where one, you got to solve for a buyer that's going to be interested to jump into the deal that you have, where you may be competing with a lot of guys that are going to be dumping as well, who those buyers also have the same financing quandary to solve that you just went through. So it still has to pencil for them, so, you're in a tough spot, and you may end up selling out sufficient to pay your debt, but you might end up taking a haircut on the equity you ended up putting in, even if you performed well as an operator or developer of that asset, where you took it from point A to point B and actually created value, but the market turned on you. So the value is now like less than where you started potentially. So I see that materializing, and those distress type situations materializing, at least in the next few quarters.
It's very interesting. You talked about a lot of things here, and it seems like it's an interesting there are many views about when the Fed is going to start pivoting. Some views are thinking, okay, well, look, we're going to get to like a 4.5% terminal rate, probably fairly close, maybe 100 basis points away from something when they stop or break the system. So let's say they stop around the turn of the year, right? Or they pause at least at December or January. That's sooner than your more or less prediction that sometime in 2023 is going to be tough, which implies some sort of overhang, right? And a lot of things that I've read about real estate is that there's probably a 3 to 6 month lag, or maybe a 6 month lag between this interesting phenomenon where consumers now are still thinking, okay, well, the rates are rising, they might go up later, so I might as well get out of my house, or buy now so I can lock in this high rate, but it's going to not be as high later. So is there some sort of overhang, like a Wile E. Coyote moment, where you realize you're running, but there's no longer a ground underneath you? You're kind of over the cliff, and then and then you fall. Is it going to be like, hey, end of Q1, beginning of Q2 of next year, when the market really starts drying up of deal makers?
Well, so let's start with the premise of the Fed actually, throttling back or even stopping.
Pivot.
Right.
This is what we're going
I mean,
for.
like the public markets obviously, are ready for this. Whether the economy is, and that's obviously the Fed's call to make. But, every time there's a signal or a rumor, like you could see the market reacting to that. So we know where the public markets are going to go once the Fed actually starts to signal like, okay, this is enough. But real estate, and I say this regularly, it's a big, fat, slow moving fixed asset. And so whatever is happening, in the capital markets, in the public markets, you have this lag time associated with how real estate processes those very same consequences. So even if you start to see, the capital markets turning around, and again, the public markets reacting in real time because of its efficiency, it's going to take, you definitely have the overhang that you mentioned associated with that, that I think is going to take definitely some time to process, and the funny thing is it's not like a quarter, 2 quarters thing. You're dealing with so many elements. You're dealing with the psychological element of the buyers and sellers, and where that like bid-ask strike is on pricing, right? Just by virtue of the fact that, buyers both genuinely and opportunistically take the position that, money costs more money now, therefore pricing should reflect that, and sellers saying, but my asset's amazing, it's worth more than what I even own it. I bought it at, or, where, the market even was when it was hot. So, you're going to have that lag time coupled with the fact that, ultimately it comes down to, capital access versus interest rates for the most part, and that's the one thing that I think distinguishes this market cycle, as recessionary as it is or will be versus, the last one. The last one, what really impacted real estate, which also had like that, call it lag time, it was pretty precipitous, and it obviously, led the downturn, but, you didn't have capital availability, like period, right? Lenders and all the sources of debt capital just dried up, partly because they just disappeared and they went like bust. But also a lot of them were just very skittish about entering back into the market. And that's really what created the whole debt fund world that now exists today and become much more institutionalized. But we don't have that issue right now. Lenders are being cautious. Lenders are being disciplined. The government's got all these like capital ratio tests that they're implementing in real time. And so lenders are being, maybe they're being a little more selective. Maybe they're not putting out as much, but the money is still there. So things are still moving along, right? And so as the rates calibrate as maybe the inflationary environment calibrates. Capital and the capital sources will calibrate to that, but they're not going away. So I think that keeps the engine going. So slow down and dead stop are like really two different things, and two different I don't want to say crises, because the first isn't a crisis per se, but the second one is, right? And I think that's really the distinction here that, to pay attention to. Because even if you look at, and I've looked at this historically, okay, you go back and look at down cycles, particularly as it relates to real estate, REIT pricing, and then you cross-reference it with what the interest rate was at the time. And like the correlation was much more tied to capital availability than what the interest rate was. So in certain instances, you might have had an interest rate environment at 5, at 7 or 8, at 6 or whatever it was. But if lenders were lending, then it wasn't necessarily like, as impactful as like when they completely pulled back and they were just out of the market.
Yeah. So, wow, I was going to go into commercial versus residential, but before we do that, when you say capital availability, right? What are some signs to look out for if you're an investor and you're investing in real estate, whether directly or through paper? What are some signs to see specifically capital availability within the real estate market?
So look, the most transparent and readily available source is going to be your public market debt, right? So, you're talking about agency debt like Fannie and Freddie. You're talking about looking at the CMBS and CLO markets, that support a lot of real estate lending, right? Because that's just public market data is available. You can see it. You can see its trends. You can see also the delinquencies associated with that. So that's always the easiest gauge is like one form. You can look at banking activity, right? Regulated banks have a certain allocation to commercial real estate. So that's another form of really tracking, the capital availability, right? I mean, and when I say that, obviously, I mean debt particularly, because that makes up most of the stack in any real estate transaction. So that's really what everybo's most sensitive to. It's a highly levered asset, right? So you want to really be tracking that mostly. So those are just like a couple of places to point to and really look at. There are a lot of these like market reports that are just like publicly available where you can see like, okay, how much did the banks put out in commercial real estate this year or this quarter? How much did life companies, life insurance companies do as well? Every player in the space, and what have they done? Have they pulled back percentage wise? That's really where I like to look just to see. And granted, some of it is opportunistic because we're going to jump in and try to pick up the slack where we see some good deals that are just, baby with the bathwater situations. But, otherwise, it's also just good to keep your finger on the pulse on a macro level.
So you mentioned mortgage-backed securities, MBS. How much of, look, there was a buyer of last resort or first result was, essentially the Fed. They were just buying MBS up until about May this year, if I'm not mistaken, but I could be wrong in the month. Now that buyer is out, right? Obviously, it reduces the availability of money and cash in the systems, which was propping up real estate prices before. How big of a hit is that? And do you expect them to come back in after a certain point? So maybe I should clarify, there's going to be a pivot on interest rates from the Fed, right? And there's probably going to be some sort of pivot of, will the Fed actually go back and buy mortgage-backed securities? Do you think they would? And yes or no, regardless, how big of a cash suck out of the system is the Fed stopping buying MBSs?
I think, look, it's always convenient, to have the government picking up, MBS.
Buy my house.
Yeah. buy my house, fund my debt. I mean, it absolutely is impactful. I think the Fed had definitely did a good job of signaling when they were going to slow down and stop, so that the market could prepare. And I think they were doing it through a pretty hot time in the market that it could absorb that news and really just like taking the training wheels back off, so to speak, as to just how the whole engine was working. I don't necessarily foresee the Fed jumping back in because this isn't a crisis situation as much as it is a fundamental economic cycle that, again, you could appreciate academically, but, sucks maybe in real life when it comes to like buying things. But when it comes to them being out of the market, I don't necessarily know that you're seizing the market up per se. I think that you're just going to have a very traditional capitalist oriented, supply demand dynamic where the long-standing buyers and even new entrants may be commanding much higher yield on that product, which has that cascading effect of saying, okay, well, we've got to go out and originate higher interest loans to satisfy our end buyers. And the question then becomes, are those loans in line with the same rates that traditional banks charge? And, as a borrower, you can go shop around and see like which source makes the most sense for you. But I don't think it gets to a point where like MBS goes out the window. I think you just have too many groups that really like that product, that it's just going to continue along. Again, there may be a repricing element associated with that. I mean, there certainly is. Does that continue? That's, I think, a question, but I don't think it seizes up, or I don't think it needs government intervention because I don't think it's a crisis.
Yeah, so before it's an interesting point, not a crisis, because the government started doing this during the great financial crisis. And yeah, so like they're stopping now. We'll see if they go back in. There are other macro wins here, whether we can sustain such high yields on government debt in general, what's going to happen with M2, which is the wider money supply. But I do want to pivot to commercial versus residential. But before I do, I want to ask about my home, the DC area. So the one I read, I'm going to look up this guy on Twitter now, but it's Michael Kantowitz, I think, or Kantrowitz. He's I follow him a lot on Twitter. He's the chief investment strategist of Piper Sandler. He's very good. He basically has this thing. He's like, analysis of averages leads to average analysis. And so we're always talking about on kind of global terms, but the U.S. is a very patchy market, right? So I'll leave the thunder to you, so to speak. But when you're looking at the U.S. overall, there are certain areas where real estate prices are much more susceptible to the ups and downs. Like in the great financial crisis, Vegas was pretty much, and COVID, Vegas was just, abandoned, right? And Vegas suffers a lot from this. DC, on the other hand, doesn't. Do you see the same patterns? Do you see certain areas of the market that are more susceptible to a downfall and ones that are less susceptible to real estate prices falling?
So I think, you can segment that certainly by geography. And I think you could also segment that by, whether you're talking about the like luxury end of the market versus, just like your standard either house or condo for a traditional home buyer. So I certainly think that the luxury end of the market across the board is certainly getting impacted right now, which, you can make an argument to say that it's the kind of asset class that somebody who has just a ton of cash isn't necessarily going to be as rate sensitive. But those, that same cash pricing and the dollar swing associated with the price tag on these particular properties is significant. And so you're starting already with a smaller population of buyers to begin
Mhm.
with. And not only that, but it's just like you really got to hit the bullseye, especially if you're like a home builder or someone who's like, a renovator of like those types of homes. It's got to be in the right location, nothing funky about it, and things like that already create a small population of buyers that is your exit and source of profit, such that when you hit, times like these, it tends to even thin that out somewhat, whether it be because of capability, interest, or just a wait and see kind of approach. With respect to like, you know, geography, your prime higher density markets, already have this like out of whack, so to speak, supply demand dynamic to begin with. Um, I would say that that was like manifest in the insane pricing that a lot of people were just being blown away by, when the market was just on fire. I think that the slowdown is certainly impacting those markets. So you talk about like New York, DC, um, but there's room for a pullback. There's only so many people that can drop, call it that $1 to $3 million pricing. Like those people, have
Yeah.
capability and certainly, have some money. Um, but the interest rate environment also impacts them, in terms of what that carry looks like. And, so I think that there's going to be some pullback there, and then, you also look at some of the maybe like high growth markets that really benefited from the last few years. You talk about like Miami or Nashville or in Austin, and I think there, the thing to also consider is just, what's driving that in migration into those markets. When you have things like industries that have been really driving a lot of why people are moving there. So Austin's got a very, strong tech scene. Miami has just, seen the benefit of, everything related to how it kept, business going through COVID, but you also have just like a lot of financial institutions moving. That never stopped even after the great reopening. You've got this growing tech scene, crypto, and regardless of what each one of those industries may experience, the fact is anyone that's migrating on a commercial basis to a given location is not thinking about the next, call it even year or two, as much as they're thinking, long game, just about where they're setting up and why they're setting up. And so that brings with it people who are obviously going to be working in those firms and those industries, which translate into a housing need, right? That still needs to be satisfied. Now, you can get into the whole, okay, are they renters? Are they buyers? And I think certainly like you start to then maybe have somewhat of an effect of where we are on a macro level, having some influence there. But if you've got people coming in, like it's a good news story, right? And the vibe does not feel, recessionary to a large extent. So maybe you'll have some people maybe hanging back just to see where the market goes, but they're doing that opportunistically, right? They're not like, it's not a doom and gloom analysis. It's like, oh, I'm just trying to market time right now on when I can jump in, because I want to like plant a flag here and like this is where I'm going to set up, my like base on a personal basis and, probably professionally as well.
Yeah. That's an interesting point. So let me I want to ask you before I let you go because you're a wealth of knowledge. Commercial versus residential. We've been talking a lot in general and anchoring on residential. Let's talk a little bit about commercial. One, we have a slowdown, but two, there are all these tailwinds before or actually headwinds, I guess, from a real estate perspective of COVID changed everything. People aren't going to go back to the office as, in the way they used to, and they're going to work from home. At least it'll be a hybrid working environment. So a lot of companies are downsizing. Do you see that continuing? Is that still a true statement, or is that something that was a fad and true for, 2 years? So how's the commercial market performing and affected by all of this?
Interestingly, retail is recovering much quicker than the office was, and I think it got more of the beatdown during pandemic than office did. Not that people weren't considering office at the time, it was just the higher profile asset class, just because it's just by its nature. Where now you're seeing people getting out there and still shopping and still buying, and people are signing up leases, and retail's just been kind of doing all right, and lenders are willing to hear out the prospect of financing assets like that. Office, I think, I think office continues to trend towards a recovery, but it's one of those situations where I think call it, secular shift in office really has to do with how people work, right? So that hybrid element of it. But with all that said, you're reading about how there's just been a just strong influx of people getting back to work after the summer. More and more people coming into the office. So maybe it's not 5 days a week, but they're there more than they've ever been. And that seems to be a growing trend. And I think it's a combination of certainly the companies saying, okay, party's over, let's get back to work, in terms of having presence. And I think people want that in their life and their routine as well. So, going back to the asset class, office is a catch-all, right? But the reality is, where you're seeing a lot of the activity, and there's always announcements of big leases getting signed, or big buildings getting leased up, or, things like that. It's the newer product, the more recent developments, the better locations. So you look in New York at Hudson Yards as an example, or new developments in Wynwood in Miami as another example, but just new product, downtown locations, those are really the hooks for a lot of the tenants that are signing up leases, because there is a consideration as to getting people in, right? Forcing people into some crap location office is just, you're going to end up losing staff, because it's just a downer to be in these cookie cutter, old school looking offices. And I think that, one, there's going to be sort of a sorting out of which properties are going to survive. And I think you're also going to see either the existing owners or new owners coming in and doing their very best to revive these properties with some serious upgrades, just to make them viable as an investment, long term. And I think it's going to take time for sure. I think there's just going to be a lot of things that are just going to die out and maybe be demoed, turned into other things like apartment complexes, or, self-storage, or whatever the better use is. I think so. A lot of that is going to certainly happen. But you see that on the retail side. You've got a whole segment of dead malls, where it's just there's crap tenants and bad locations that just die out. But then in contrast, you've got phenomenal lifestyle centers that maybe just either get built or got built right down the road, and they're crushing it, right? So it's not there's an element of obsolescence to the entire asset class, right? It's just an evolution, if you will, related to those. And that's frankly how it should be.
It's interesting what you just mentioned. There's a couple of themes in there. One, retail is recovering better than typical commercial office space. And maybe I'm using the wrong terms when I say commercial, but retail stores versus office space. But the second is that when we're thinking about, academically, you said, look, from an economic perspective, the whole recession and downturn makes a lot of sense. It also makes sense to get rid of the deadwood. And this is exactly what we just talked about. The office space that was just there, that's not great, the malls that are deadwood malls. I have some around me that just have been kind of floundering for years and years, and COVID brought them down, and they've never reopened because they need high traffic, high velocity, chic stores, things that brings excitement. What I'm gonna, and I'm not holding into these numbers, but I keep on asking about these numbers just from a high level, just to create some context and magnitude. What perspective of, let's say, commercial retail, this mall space, and then office space, do you think is deadwood? So how much are we, is it going to be a 10% haircut, a 15% haircut? Is this even a way to, the right way to value it?
So yeah, I look, I think it's hard to point to the entire asset class and say it needs to be repriced to X. I think it's much more of a sorting out of those assets that warrant being valued versus the ones that, just like to your comment, are deadwood and need to go. So I think that that's much more of the analysis at the moment. And look, I would say with retail, that was happening way before the pandemic, and retail was trying to figure out what its next version needed to be, and so experiential like became a huge component of that. And then of course, unfortunately, the pandemic just affected that because nobody could experience anything. But then, you look now and, that element is absolutely still prevalent and back as a component of retail. And, you have the omni-channel element to it with integration related to technology, whether it be how you're shopping or, even bringing in some elements of, crypto to the retail experience now, and so just kind of blending all of that together. Office unfortunately doesn't have that creative latitude, and so there I think you're really, going to be bound by, the vintage of the asset, meaning how old your property is, and what kind of amenities you're able to either offer up or you're developing into newer assets. And, if you're in the very classic sense, location, are you in the right area that even if you, listen, so there's just some crappy offices that are just going to always kill it because they are just 100% in the right corner, but I don't know how much people are willing to tolerate even that, to some degree. So, I think that's really what's going to happen. And look, I think, you're asking a pricing question and a value question on an overall, and I don't know that you're going to necessarily see people saying, well, office is just too risky an asset class, or, it's going through changes, therefore we should adjust pricing down to reflect that reality. In the end, investments are made based on, the numbers. So the question really becomes, how much occupancy can you get into a building and how much rent can you charge in that building? And that's going to in turn provide you with some implied value along with other inputs. And I think that's really going to be more of a driver than simply, doing a catch-all, well, office sucks right now, so we're going to haircut the hell out of it. It's more just a binary, very close look at, okay, is this building class A with phenomenal tenants, with long-term leases and a good location, or, is it not? And do I, investor, or do I, lender, even want to put dollars into this on a, go, no go basis?
I think, this is, we're going to see, this is kind of the macro environment of our lives, so to speak, of our generation. And we're going to see some interesting, as you said, there are a lot of various winds and degrees of freedom that are coming in and out. in terms of what's going to happen to the market. And I know I keep on trying to push you on price and get you to bite, so to speak. And look, for me the overall movement and trajectory is interesting. But let me ask you this, because I do want to I want to bring this up in the last 5 minutes or so that we have together. Is what are you telling your clients from uh, uh, CapStack perspective? Sorry, I'm kind of losing my words here. What are you telling your clients? How are you advising them to manage money? What are you guys doing, right? So when people are listening to this pod and they want to come to you, what are some things that's important for you to get out in the market?
So, look, I would say, we manage a debt fund, and so we see a lot. Like, it's a good vantage point for what we're doing. And the stuff we're touching is, the opportunistic direct lending opportunities. So we're filling the void where traditional lenders may be a bit skittish right now. And we're also buying distressed opportunities, which that's my background, and frankly, we love. So, I am, my view has simply been that we're going to make loans on a deal by deal basis, where we like the story, the asset, our last dollar risk in a deal. We feel like we can get a return that is reflective of where the markets are, meaning, my yield has to be significantly higher than where rates are, certainly. But also, look, I have investors that don't necessarily just invest in real estate or just invest in real estate debt with us, but they're investing in the public markets, right? So you have to look over and say, okay, what are the public markets doing? What are, whether it be fixed income or equities? And I know, like, equities are getting hammered, but fixed income yields are a very measurable benchmark, right? So we look at that and say, okay, if we're going to go into a deal, like, we have to offer something compelling. So that's generally where we're starting, and then we have to just, like the story, like the deal. And that's really the room you have when you're looking at, like, these, like, private real estate opportunities that you can jump in on. And on a distressed basis, a lot of investors that we deal with, everyone likes distress. It's sexy. People just love the idea of getting a deal. I always say, you don't buy price, you buy value. We've paid par on defaulted deals in that, using that lens. Everyone wants to just get a discount for the sake of it. I do believe that you'll start to see that over the next few quarters, because, if you go back to what I was saying, where you're going to have borrowers running into problems on refinancing loans that are coming due, right? On the one side of that trade, you have a borrower problem. On the other side is the lender counterparty to that relationship, who also now has a problem because they want to get repaid and get out of the deal, right? So to that end, I have been very, very slow moving, even though deals, and as an opportunist, and trying to make good investments and good yields, we're starting to see things that we haven't been able to see in the last few years. I feel like we're not going to lose out. We're taking our time. I'm definitely in a little more of a wait and see camp. As deals come our way, if we like them and we can make the deal happen, we'll do them. But we're not jumping in out of an urgency that if this one gets away, we're like left without any other opportunities. I think, there's going to be a window of time, and it's probably a near-term one, not a long-term one necessarily, where I think, you can just kind of take your time, be selective, make smart decisions. And I would also just add, and this is something that I counsel on a regular basis, when we're bringing new investors into our fund, and just in general, when I talk to people that directly invest, think about your runway. Think about your runway, right? If you're being short term, just think about the kind of market environment you may come out on the other side of whatever trade you're doing in the short term, and whether it's going to be conducive to what you think your exit's going to be, right? If it's longer term, that's a different analysis. So, those are the considerations, that especially, particularly again, because real estate's not a public equities. Like you can't jump in and out of that, right? So you really got to think about like, okay, when am I getting off this ride?
Well, look, we're gonna have to wrap. We need to have you back on a third time, but how do people find you for those who haven't seen you before? How do people learn more about CapStack? And yeah, how do people turn to you?
I'm active on LinkedIn, so you can always find me there. I think that's probably the best way to go. I'm most reachable and most active on that platform.
Awesome. We'll put a link down below. Thanks again. I'm gonna have you start managing. I'm just start investing in your company. Start managing my real estate investment. But yeah, look, thanks for coming on again. Really happy to have you. I've learned a lot. I mean, just thinking about the price action, we should maybe revisit this. It's October now, maybe January, February, and see where the market is going. Hopefully, it's after a pause or a pivot, or at least a pause, and there's gonna be that overhang that we talked about. And it'll be interesting to see, because real estate is usually the last piece to really turn over when we're going from economic cycle to economic cycle, and so it's going to be quite interesting to see the fallout that happens. And depending on the kind of recession that we're going to be officially in next year, that everybody's now forecasting. And now we're not in a recession, but next year for sure, it might be quite an interesting market environment for sure.
I think so.
Well, thanks for coming on.
Thanks for having me again.